Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
All right. Hi, everyone. Welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and today I'm joined by Tracy Rewey. So, Tracy, how you doing?
I'm well. Thanks for having me on the show.
Yeah, no, thanks so much for coming on. I was really excited when you offered to come on because I know you have a lot of experience in notes that goes back way further than it does for me. So maybe we could start by talking a little bit about how you got started in notes and how long you've been at it.
Well, I've been at it 30 plus years. I got started in 1988. I went to work for a company that bought and sold seller finance notes, private debt. And they used insurance funds and securities, and they took that money invested in notes. And so they did that mostly in the Pacific Northwest, where I was from. And then they branched out across all 50 states. And so I was with them about 10 years. And then in 97, I went out on my own because I got tired of seeing all the money the investors were making. I wanted a little participation in that. And so I've been doing that myself since 97. And my focus continues to be primarily seller finance notes.
Very cool. I mean, how much activity was there back in the 80s? And that was there a lot? Yeah.
Yes, because the interest rates were so high.
Okay.
So there was a lot of seller financing. And then there was a lot of activity in the 90s and the 2000s as well. And then, of course, when the crash came in 08, we saw a lot of lenders pull back. And so we saw a big surge in seller financing then again. So we have a lot of inventory that's in the books now. And the great thing is that real estate prices have come back, right? So as the markets come back, buyers aren't underwater anymore. So it's still a really great time for inventory in the seller finance world. I know there's a lot of people who buy defaulted notes, and I always jokingly say I have enough notes that I bought that I thought were going to be performing that turned non-performing, that I'm not in the market that I normally go look for them. But I bought some reperformers out of a few portfolios and stuff too. So I get why people like non-performing. I've just always liked the performing first position seller finance notes. It's always been my sweet spot.
Yeah, I mean, right now the non-performing space seems to continue to get, a little bit tighter and tighter just because the economy's hot and foreclosure rates are low. And so it's maybe not the sweet spot of the cycle for that.
Anyways. I would agree with you. Yeah.
Yeah, for sure. So now I guess, like, where do you see the market heading, right now? Do you think there'll continue to be a lot of seller finance notes?
Yeah, so we track those numbers every year, and we release all the stats on our website at noteinvestor.com. And so we saw, in 2009, if you look at the graph that's on the site, it's kind of down here, and then it spiked up, that 2010, 11, 12, 13, and then it came down a little bit, and now it's kind of just evened out. So if 2009 was down here and 2013 was here, we're kind of evened out last few years right about here. So last year there's 25.9 billion with the B that was originated in seller finance paper. There's more than that, but those are like first liens over $30,000 balance. So we're talking, something a little more substantial. There's lots more if you add in seconds and you add in smaller balance notes as well.
Cool. So how do people get started in seller finance? And I asked this mainly because, I have some REOs now, and I haven't created my own notes yet. I've looked at doing it in a couple cases. So what I think people don't realize is, like, one of the advantages we do a podcast and have people on, you get to learn a lot because you kind of just go survey everybody from the industry when you want to know something. So like for me, like with one of my REOs, like how would you go about, finding a buyer for that and getting a note originated?
Yeah, the beauty of seller financing is when you advertise that owner will finance to qualified buyers with a good down payment. You just say owners will finance and you get everybody, and that is a little bit of a waste of your time. So it's good to kind of set some expectations.
Right.
You certainly will get people who want 0 down and 0% interest rate. And if you're a buyer, that's great. I love buying properties with owner financing, but when I'm selling, I have a very set parameters that I like to operate in. So the advertising part isn't that hard. You can do it with a real estate agent or without. There's lots of opportunities, that you can list online now with or without an agent. It surprises people, but still most seller finance transactions still have a real estate agent involved. So, that doesn't mean it's not all FSBO. That's one of the misconceptions or myths that I run across a lot.
What's FSBO or?
FSBO would be for sale by owner.
Oh, gotcha.
Yeah, I probably said I say things fast, run all my words together, right?
Yeah, no worries.
Yeah, FSBO would be for sale by owner. So a lot of people think seller financing is all for sale by owner. There's no real estate agents involved, but a lot of times agents are involved. In fact, I get some good referrals from agents.
Oh, very cool. I forgot what I was going to ask.
That would be your first step, right? Is and then the next step I always tell people is, and you're familiar with this because you buy and sell notes, but if you're going to be selling to someone who lives in the property, it's going to be owner occupied. Things changed a little bit in 2014 when the Dodd-Frank Act came along. So there are certain seller finance transactions that do fall under Dodd-Frank. Now, a lot of people say, I'm only going to sell to investors, people who aren't going to live in the property, and then they don't have to worry about that. But still, I really encourage people, there's also exemptions depending on how many you do a year, how many seller finance transactions you originate in a year, there's some exemptions. But I still tell people there's an easy solution and don't worry about it because whether the exemptions apply or not, just use an RMLO. There are lots of RMLOs out there that will underwrite seller finance deals, and they make sure that you're compliant, and they do all the disclosures, and they do the ability to repay calculation. So all of those things, and it's affordable, and then you don't have to worry about if you're qualified, your transaction qualifies or not. That's just when you're dealing with owner occupied. So
Right.
Yeah, so that's one tip that's come along. When that first came out, Dodd-Frank, everybody was like, we don't want to do owner finance now.
Yeah.
But now everybody's just gotten more comfortable. There's affordable options. You don't have to go out and get licensed as a loan originator yourself, or you may fall under one of the exemptions, or you just sell to investors.
And are you mostly, when you originate those, are you originating just traditional mortgages or contract for deeds or a mix?
Yeah, that normally for somebody that's starting out, and that's not you, I know, but if the listener is just starting out, I always recommend they go with note deed of trust or note mortgage. It's more standard type documentation. It's going to be easier to resell if you ever need liquidity. You don't want to keep the note, you want to resell it. I know a lot of people, and I bought contract for deeds as well. A lot of people like them because they say, it's easier to foreclose. But in a lot of states, that's not true anymore. They are making you foreclose on the equitable interest, very similar to mortgage even. So sometimes the deed of trust is even preferable in some states over a contract for deed. So there's other states like Ohio, that have gotten real careful on that whole contract for deed. So I really just suggest, if I was going to give you people advice on taking the safe route, is use a note deed of trust or note mortgage. Yeah,
for sure. Yeah, because being able to resell them is one of the key things. I know some people are staying away from contract for deeds, and Ohio is definitely one of those spots where you got to be careful, make sure you're doing everything right.
Yeah, and I've converted some. I buy a lot on the secondary market, so while I originate some, I primarily like to buy them after somebody's done all that work.
Yeah.
So we buy them at a discount from sellers that sold with seller financing, and they're tired of getting the payments. They want to cash out and move on to their next deal. And so we've bought some of those contract for deeds, and then we've converted them to notes and deeds of trust or notes and mortgages.
For sure. And then how do you structure those typically? So, you talk about the importance of getting a down payment, and if it seems like if you're doing this with a blank sheet of paper, there's a lot of options in how you can set the purchase price or the interest rate or the term and the down. There's a lot of variables.
There are a lot of variables, and there's no set standard. You get to make that decision and negotiate that with the buyer. And so that's the beauty of it. You can create a win-win situation. But I've been on that institutional buying side for so many years, and where we also put notes into mortgage-backed securities and sold them on Wall Street. So I tend to operate in a box. And at least if I go outside that box, I realize I'm going outside that box, and my investor pool might be different when I choose to go outside that box. So, generally speaking, if you want to sell it right away after it originate, you're wanting a 680 credit score better, you're wanting 20% down or with a minimum of 10% down. You're looking at a 20-year term. We love interest rates at 9.75 to 10, provided that there's no usury laws in your state that would change that. So, I mean, those are kind of the basic parameters. And people usually say, well, if they qualified for that, I could get in conventional financing, right?
Yeah. I was going to ask, I mean, what, because I'm thinking of like some of my properties are, sub $50,000 properties. Yeah. How hard is it to find buyers that meet all of those criteria?
So when you step down from that criteria, then you have to go, okay, if I'm going to sell this note, so it becomes balancing the scales. Do they have a decent down payment but poor credit? Okay, maybe we could balance the scales out. Maybe I can do a first and a second and just look at selling off the first. Or maybe I'll do a first and I'll sell off a partial if I wanted to recapitalize and get some money back out of it to do the next deal. So there is some balancing of the scales. But if you get somebody who has 0 down, sub 600 credit score, they're having troubles proving their income, that's another repo waiting to happen, right? You're just going to put yourself back in that same situation. So I just say be careful. I mean, you can make exceptions because you are the seller and you are the underwriter, but don't make exceptions that are going to, put you back having to foreclose on a property and the person didn't even have. I've seen deals where the person would have had to put more money down if they rented the property with first and last month's rent and a deposit.
Yeah.
Than they did to get into an owner finance deal. That doesn't make sense to me.
Yeah, because I have somebody that really, really wants to buy one of mine on owner finance, but they don't have any money for a down payment. And this is actually somebody I kind of know from elsewhere anyways. And so I'm not so much worried about having to take it back, but I'm like, how am I going to resell that on the market if I do that? I would think that like I wouldn't necessarily want to buy a note like that if somebody didn't have any down payment.
Yeah, so then you would probably need to season it up for a little while, probably show nice 12-month payment history and then sell off a partial, or maybe you would want to do a first and a second. And you can keep the second and sell off the first. So you're keeping that, investor that would buy in some towards a 50% to 60% investment to value.
Yeah, no, that makes sense. So, I mean, so what other kinds of things should folks be thinking about when they look at doing seller finance on notes?
Yeah, well, you definitely want to underwrite your borrower. So make them fill out a loan app, pull credit, verify their income. Again, use a RMLO. I really like Russ O'Donnell at calltheunderwriter.com. He's I know he doesn't pay me to plug him. I just think his service is wonderful, but he can underwrite for seller financing in all 50 states. And he's very affordable. He's under $500.
You have to send me the link to their website after this because I can add it into the show notes.
Absolutely. So he's done deals and he does a nice job putting together that whole documentation package for the underwriting side of it. He doesn't perform your underwriting. You still have to decide who you're going to sell to. He doesn't find your buyers, but it helps you package up the deal if it's going to be owner occupied and you're worried about that Dodd-Frank piece with the ability to repay. So then I still always get title. I mean, I still close it like a regular deal. So I get a title commitment and I make sure my buyer gets a owner's title policy, and then I receive a lender's title policy. And then when you go to resell it, you have that in your package as well. And, we still like to have them bring in proof of insurance that they're going to insure the property and set it up with some kind of servicing with preferably reserves for taxes and insurance. I mean, I say set the note up the way you would like to buy it.
Right.
Yeah, so do all those bells and whistles. One of the cool things when you're setting up your own notes is that you can pass on things like servicing costs to your borrower. So, yeah, so you can write that into the contract, into the agreement, that they'll, in addition to their principal and interest and tax and insurance payment, their PITI, they'll pay the servicing fee. And so whatever that is, $25, $30 a month, they send that in with their payment as well. And so it doesn't come out of your side of the equation. That's really nice.
No, that's cool. And when you're acquiring properties to create notes on, now are these like you say you don't do a ton of non-performing, so are these like performing notes that went bad and you ended up with them? Or are you like buying REOs to then create notes?
So I
against them?
personally like to find performing seller finance notes that the seller already sold the property and took back the note. And
Mm-hmm.
so I'll buy them, cash them out at a discount. I have also done it on properties I've foreclosed on, and now I'm reselling with owner financing. And there
Mm-hmm.
are deals like if you're into like mobile home and land or things like that that are harder to finance, that if you have cash, you can buy those at a wholesale price and then sell retail by selling on terms. If you're
Right.
wanting long-term interest income, some of those property types are harder to sell off the notes. So you might be doing those in your retirement account where you want the long-term interest income.
Oh, very good. Yeah, one of my challenges with some of my REOs is it seems like whenever I take one back, whether the borrower kind of rode the ship down in foreclosure or just signed the cash for keys and was ready to move on, it seems like all those folks live pretty rough.
Yeah.
And so they tend to come back in pretty rough shape. So one of those challenges I have is they're not necessarily just ready for somebody to move in. They have, they kind of require work. I don't really want to do
The
the
work.
rehab work. I do that now and then if I think it makes sense, but it's really not my area of expertise. So a lot of those buyers on seller finance ever just buy it with the understanding that they're going to have to do some fix up to get it.
Yeah, absolutely. They can put the sweat equity in for down payment, or you could do a lease option, rent to own, and once they put in the sweat equity and done the fix ups, then you could convert it to seller financing and then give them credit for their sweat equity as part of their down payment. Makes
Hmm.
them perform before you actually sell it on those terms. You could offer seller financing to a wholesaler or a rehabber who's in the area and they want to do the fix up and flip.
Hmm. That's what's nice about those. There are a lot of different options
Yeah, I love this business for that reason.
and how you can structure it. So, and then I know you've got a lot of other, like, you do some note educating and some training and whatnot. I mean, maybe you could talk a little bit about that.
Yeah, absolutely. So I'm actually finishing up my creating notes class. That's one of my new classes, but some classes we already have are finding cash flow notes. So finding real estate notes, primarily those seller finance notes, how to market and find them. We have classes on mastering partials and how to run all the calculations. It's called How to Calculate Cash Flows. So one thing I'm really passionate about is teaching people how to understand the time value of money
Hmm.
and how to put interest to work for you as an investor. And I like using small deals and everyday kind of numbers that people feel are achievable to them. Because when I was first shown a financial calculator, I had no idea what it was. And somebody taught me how to use it. And I was like, wow, so it was a light bulb went on in my mind. Because I used to close real estate. So I just saw that side of it. I thought the only way you made money on it was like you were like a real estate agent, right? Or
Right.
a loan originator. And so then I saw why banks loan money and how you could do that on privately. So that was one of my passions, was to create a hands-on training for people who hate math on how to use a calculator to understand the time value of money and interest and compounding interest and internal rate of returns and like long-term projecting. It's kind of like that old Jimmy Napier. Have you ever read that book Invest in Debt by Jimmy Napier?
I haven't read it, but I've definitely heard of. I need to go back and read it. Yeah.
It's very old timey, very old school, but it really makes you look at debt a different way. And he was around buying notes out on the East Coast here in Florida. I think it was Shipley, right? Back when we were out on the West Coast. But it's still, I mean, it's the principles in there still stand the test of time. So the training is based on that. John Richards used to do some great training on using the calculator, but it was all in a written book. But the beauty now is, you can show people using the keystrokes and how to do it right, like it's a look over your shoulder, so they can follow along and do it with it. And then I use T-value a lot, so I teach how to do it on a financial calculator and also T-value.
That's good, because when I've been selling partials, I've had people ask me questions and
Yeah.
come back and say, "Oh, I don't think this number's right," because they weren't sure how to calculate it. And then I get frustrated because I know it very well myself, but I can't really explain it well. It's one of those things. It's like once you know it, it's kind of easy, but if you don't know it, it seems kind of daunting. So I kind of encourage people that to I had a physics teacher in high school who suggested like approach things as if they're easy, and then it kind of makes it easier to understand. But yeah, that training have is really good because yeah, a lot of people just have a hard time with that, or in their normal jobs, they don't need to do those kinds of things. And so it's just foreign, but yeah, once you wrap your head around that, it's actually pretty easy and pretty fun. It's kind of cool how you can set things up.
Yeah, my husband always says, he says, I don't like math, but I like money.
Yeah,
So
it's a good motivation for people to get in there and kind of figure it out. So
it is. Yeah, it's very empowering. And even my daughter, it's like when you go to buy a car or anything like that, you will look at everything differently. You'll go,
yeah,
oh, they're making their money off me by doing this. And I need to ask this question, and it makes, and you understand, why you don't carry debt on your credit cards and, things like that.
yeah. So I was a little fortunate in that when I was a kid, my dad and my grandfather worked in the loan business, and it was actually a business doing like private loans
Ah,
back before like credit cards were real big. Like there were places you could go down and just borrow like $1,000 or whatever. And so I didn't work in that industry, but I grew up around it. And so it was kind of easier to, so yeah, I kind of learned that thing about the credit cards pretty quick. It's like, well, yeah, 20% interest rate or whatever is pretty painful. You want to try to stay away from that.
yeah, we want to be on the other side if we can, right?
Yeah. And that's what's cool about this. Yeah, you can get on the other side
Yeah.
with some
Yeah, for
pretty,
small amounts of money.
yeah, for sure, for sure. So, so like what other kinds of things do you think that like new note investors need to learn or, may not be aware of as they're trying to get started
Yeah,
in
so
the
I have a
business?
blog with about 300 articles. It's called noteinvestor.com, and I have my 21 tips for first-time note investors. And I'll go over all 21 today, but definitely
Yeah.
go there, download it. But one of the things that I get surprised about still to this day are people who go to buy a note and they don't get the original note, they don't get an assignment, and they don't get a note endorsement. So, I
Oh,
mean,
wow.
yeah, and it's like, no, you want the original note. It's like a check. It's an obligation to pay, It's like you got to get it endorsed and signed over, and you need to get an assignment of the mortgage that gives you a lien on the property if they don't pay, and you need to check that the person selling it to you, has that assignment if they weren't the ones that were originally on the mortgage or the deed of trust, that there's a chain that follows from A to B. And
Hmm.
and so that's like that surprised me the last couple of years, because that to me is just like, you wouldn't buy real estate without getting a deed, you wouldn't buy a car without getting the car title. So that's like the first place I start with people, is like, make sure you understand how you show you own that note.
Yeah, I'm actually helping somebody with one right now where they bought a performing note and they didn't really know anything about it. And then it stopped performing and they're like, what? And they didn't even know if they had all that stuff.
Yeah.
It turns out they did.
Yay.
So that aspect was good. But I was pretty quickly was able to determine that, the property was vacant and there were all kinds of problems. So I'm helping them get that
Yeah.
worked out, and borrowers willing to do a deed in lieu. I was able to get it going pretty quickly, but yeah, when people don't know, they don't know. But yeah, fortunately from a chain of title perspective and all of that, he was
Yeah,
in
so
good
that's
shape and
great when
covered.
it's performing, but when it's not performing, you go to enforce it, and then you're going to have to provide evidence. Or if you ever want to sell it, you're going to have to provide that. But so those sorts of basic things, how to perform due diligence on a note. I know that's a topic near and dear to your
Yep.
heart. Congratulations on that new due diligence class you just released.
Oh, thanks. I appreciate that.
Yeah. So how to perform due diligence. So what you should be looking at. You got three things, the three P's, right? You've got the property, you've got the paperwork, and you've got the payer, the buyer, the person making the payment. So, those are the three things. Understand how equity plays into that, and property condition. And if you're buying non-performing, you've got the whole gamut of if it's judicial or non-judicial, and how long it takes to foreclose, and how expensive is it to foreclose, and what are
Yeah.
eviction laws, and we think about those in performing as well, but we're really trying to underwrite it so we believe that it is performing and it will continue to be performing. And if it's not, are we equity protected, that we can go in there and take back the property, preferably with a deed in lieu, like you mentioned. But if we had to foreclose, would we still be made whole? And hopefully still
Yeah.
make a profit.
That's how I look at performers too. I'm kind of looking at my yield and everything, and then I look at that as a backup plan. If this does go sideways, can I get out? without getting hurt. But whereas when the non-performing side, you're actually kind of sometimes planning to go down the foreclosure route and then want to make a profit.
Yeah. So
That way.
I'm with you. I'd always rather do a deed in lieu. Well, I'd rather get them performing again if there's any possible way. Do some kind of workout or repayment plan or restructuring. And then second, up deed in lieu if that doesn't work. And then if you have to, then you have to foreclose.
Yep, absolutely. Yeah, I'm always happy. I've been, it seems like lately I've been on a decent run, especially with land contracts, of getting people to sign cancellations. But then what I found in some cases is they were willing to move on because the furnace was broken and winter was coming, or there were other problems there. So it's like, okay, it's good I didn't have to spend $5,000 or whatever on the foreclosure. But sometimes if somebody's too willing to sign a deed in lieu, it means that something's up with the property too.
That's very true. Yeah.
Yeah.
Another thing that's happening a lot in owner financing right now is, and you have to understand this process and document it correctly and involve your team. So if you're going to do these sorts of things, your team definitely needs to include a real estate attorney and a title company and a servicing company and an RMLO. But you can do wraps. So you can buy a property and get it owner financed, and you can sell a property and owner finance it. And so it's a way to create a leverage or an arbitrage. You just got to make sure that the interest rate you're paying is less than the interest rate you're earning. And you can do some spreads that way as well. So there's a lot of, you said, where's the inventory coming from? We're seeing a lot of people that are wholesalers of property, of real estate, that market's shrinking as well. Their profits are shrinking. And so by adding seller financing to the mix, they're able to do transactions with those wraps that they might not otherwise be able to do because there wasn't enough money in there just in the traditional buy, sell, fix, that sort of thing.
Yeah, one of the things I like about notes versus some of those other industries like wholesaling and other things are there's just not as many people doing notes. I mean, sometimes people complain there aren't enough deals or whatever, but I haven't worked in those other areas, but it just seems like there's a lot more in notes. You're not fighting 10,000 people for the same deal.
Yeah, I agree. And the other thing we have to look at too is that we've got to realize that real estate prices are at a high. So you just got to be careful that your ITV can take a little bit of a hit if prices in real estate come down. Because in 08, 09, 2010, we held notes where, having been in the business 30 years, that we were in at 50% investment to value, and then we turn around a few years later and they're at 100% loan to value because property rates fell by half, like in the state of Florida where I currently live.
Yeah. Oh, what part of Florida are you in now?
I'm in Central Florida. Yeah.
Okay, I grew up in Melbourne, so that's kind of my.
Oh, yeah, very nice.
So.
I think I saw that on one of your blog posts or something. You talked about you were down in Florida visiting.
Yeah, I have a lot of family around there, so I get down there usually at least once a year.
Yeah.
Sometimes twice or so. So yeah, it's a fun place. Although I enjoy Colorado, so it's been good.
Yeah. Well, I went from Washington State in the mountains on the Idaho side to Florida, and you went from Florida to the mountains.
I went the other way. Yeah.
Yeah.
Which wasn't too bad. Our winters are not as bad as everybody thinks. Some of my friends thought I was moving above the Arctic Circle or something, and it's like, well, it's not that bad.
Colorado's pretty. I have some family in Colorado. It's a gorgeous place.
Yeah, it's not like the northeastern winters. It's usually pretty sunny and usually pretty dry. It will get super cold on occasion, but yeah, usually it's not too bad. I like it. I couldn't live in like New York or Boston or something like that, but Colorado works.
Yeah, well, on the side of the mountains I was in Washington State, we got way more sun than like the Seattle side. They're very gray over there, so.
Yeah, so I wouldn't like that. I would get depressed and it just wouldn't go well. So.
Our daughter lives in Salt Lake City now, and I've been out there to visit her a few times. And they have some nice sunny days in the winter too.
Yeah, Utah is nice. I especially like the national parks and everything.
Which is definitely. So, where are you liking to buy notes right now, Dan? Where's your sweet spot?
Yeah, so my sweet spot has kind of been Michigan and Indiana for the most part. I still have a lot of Ohio stuff, and then I'm still buying some stuff in Ohio. I'm just trading a little more lightly just because everything's kind of changing there. And then I have a bunch of contract for deeds there that I keep meaning to convert to notes. I just haven't gotten around to it because I've been just busy with
it takes time, right?
Other stuff. Yeah, for sure. And then a few in the Carolinas, and then some in Jackson, Mississippi. So they're a little bit scattered, but that, kind of Midwest
Yeah.
sweet spot. And then I even have some in like Kansas and Nebraska where not a lot of people buy,
Yeah.
but I kind of like those areas as well. But what I really want, I don't have anything in Florida right now, but I really want to buy a bunch of stuff in Florida. So what I eventually want to do is have like a golf condo and have more of an excuse to spend more
I was going to say in the winter, right?
in the winter. Yeah, exactly. In the winter. But right now, the Florida market just seems pretty tight. They're in that, one of those cycles where everything's high, but having, known the history there going back like to the 1920s, there will be another crash, and I'll be ready.
Yeah, that's what my husband and I say. Let's wait for the next crash. The other opportunity in states like ours is to look for notes that are older, right? So you can market to seller finance note holders that maybe, originated the note in 2010, 11, 12, and now property values have come back and that buyer hasn't paid off yet. I mean, there are certain ones out there, especially if you're willing to look at things like land and mobile home and land or some odd use kind of properties. So, you're not banking on the higher values. It made sense even down when values are lower. So you can kind of pick and choose, even in the states like Florida where appreciation is a little bit crazy right now.
Yeah, for sure. Well, Tracy, thanks so much for coming on. I really appreciate it.
Yeah, thanks for having me. I appreciate it.
All right. Well, thank you.